Hey Wizard, Sean here. So today we're going to get a really good understanding of what futures are and specifically how they relate to crypto so that you can make money as the price of Bitcoin goes down and you can hedge with leverage. So let's get into it. Now the first thing we should cover is, what is a futures contract? Now a futures contract is a type of forwards contract or derivative where you can fix the price for an underlying asset at a determined date in the future. Now they're different from options contracts, and we'll get into that in a bit, because there is actually an obligation to follow through with the contract. Now let's step back a second and actually explain what I just said. Let's pretend that you own some kind of supermarket store and you sell corn. Now, you are sick of seeing the price of corn fluctuating every year, and your profits and losses are just so unpredictable. So what you'd like to do is actually fix the price of corn. Now you can see it's also to the farmer's advantage, because the farmer's having the same problem. So you go over to Mr. Farmer or Mrs. Farmer and you negotiate with them to buy some corn. You say, look, 1 year from now, I would like to buy corn at today's spot price of $3.70 per a bushel of corn, and I need 100,000 bushels. Do we have a deal? Now, basically what has to happen is the farmer has to make a decision. Either they can fix their price today with you and they can have certainty, or they can just let the market decide and turn you down and say, well, no, son, let's see whatever happens with the prices. If the prices go up or down, I'm happy to take the risk. In which case you'd have to find another farmer. But let's assume that the farmer says, yep, sure, no problem. So now there's an agreement. You decide to lock in the price. The seller has the obligation to give you the corn and to deliver it, and you have the obligation to buy it and take it on. Now, one contract is worth 5,000 bushels. So you need 20 contracts to make sure that you're going to get your 100,000 bushels of corn 1 year from now. However, there's one thing that the farmer's not happy with yet. He's not going to sign yet, or she's not going to sign yet, because what they want is they want to make sure that all costs are taken into account. So for example, you have to look at what's today's spot price for corn, what's the risk-free rate of return, as we discussed in the previous video with options. Again, if you haven't seen that, go back and watch that video. The time to maturity, the storage, delivery costs of the corn, etc. All of that has to be taken into account. There is no premium here like options, so you can make and lose as much as the price goes up or down times your leverage with futures. With options, we saw how you can fix and limit your risk. Futures, this works differently. This is a different animal altogether. So anyway, once taking all of that into account, you agree to secure the contract with a total contract value of $380,000. So the spot price is $370, but you both agree that $380 is a fair price, and you enter into the contract. Now, of course, contracts aren't normally done direct with the buyer and the seller. You go through a broker for that kind of thing, but it's just to illustrate the point and to make it nice and simple so that it's easy for everyone to follow. But now here is the interesting thing. You do not have to give Mr. or Mrs. Farmer $380,000 today. Nope. The agreement is to give them a deposit of 5%. So the amount that you need to actually get into the trade is only 5% of the total value, which is awesome. You also need, and your broker will make sure that they keep you honest by ensuring that there is a margin maintenance on the account as well. In other words, if the contract starts moving against you, to make sure that you're good for the money, they're going to ask you for some more money to make sure that you can cover what you need to, and Mr. or Mrs. Farmer are not wasting their time. So there's also this thing called the maintenance margin. But essentially, to get in on the trade, assuming you have this reserve of money in case the price moves against you, you only need 5% of the total contract value, meaning futures are leveraged. Just like we saw with options, you can make money as the price goes up, but you don't need the same amount. Let's bring this back to Bitcoin, because here's the thing. You can make money as the price of Bitcoin goes up to the same profit you would make if you owned a whole Bitcoin without forking out as much money. So this is known as leverage. Now, I need to warn you, huge warning over here. Only use leverage when you know what you're doing and it makes cents. I'll talk about that in a bit. But what you need to know is that you don't need the full $380,000. You only need 5% of it to enter into this contract and agreement for your corn. Now let's say that the price goes up 20 cents. Well, this is great for you because you've actually made a $20,000 profit and you only needed $20,000 of capital to even get into the trade. So $20,000 worth of capital on a 20 cents movement on $3.70, which was the spot price, you've made $20,000 in profit. Now, if the price moved against you, you would also lose $20,000. So again, futures are highly leveraged. You need to know what you're doing. There needs to be a reason why you're investing in futures, or what you need to do is just invest with less capital so that you're risking the true amount of capital that you actually own. Here's the advantage though, right? When we're talking about Bitcoin, you can make money as the price of Bitcoin goes down. You can have a reserve of capital and you don't have to have it all trading. You can put a little bit in and that little bit is going to make you a lot or lose you a lot depending on what happens with the price movement. But if you're mining Bitcoin, this is actually fantastic. Let's say something could happen, you know, that there's some kind of meeting or announcement, and whatever comes out of that meeting or conference or announcement could mean a lot of great stuff, or it could mean a lot of bad stuff for you. And so you only need a little bit of capital to actually secure hedging against that, i.e. if the price of Bitcoin shoots up and you're mining, then great, you're hedged. So you don't actually make money because the futures price is moving up against you. But if it moves down, then you're also not losing money. So you're still in the same position you were today, and you only needed a little bit of capital to secure that position, which is awesome. You can hedge against uncertainty. You need to be prepared that if you own that Bitcoin, not to over leverage yourself. So you're not going to make too much money, you're not going to lose too much money, you're going to be about where you are today. And this just gives you peace of mind, just like the farmer with the corn, and just like the person who ran the supermarket, i.e. you in this case, who wanted to make sure that they could still sell the corn for what they needed to. So this is really, really, really good for hedging. Let's look at some differences between futures and options. And again, if you haven't seen the options video, go back and watch the options video. It really goes in depth in terms of how options work. Very different animal to futures. Also, loads of advantages. I love options. So with futures, there's an obligation to deliver. There's a higher risk potential, higher reward potential. Now take that with a pinch of salt, because if you sell options, then your risk can be huge if you're selling them naked. If you don't know what that means, again, you know what to do. You need to watch the video. Now with options, there's different ways that you can take profit. You can take profit either by closing the agreement or exercising your option, taking the opposite position, or at expiry. With futures, profits are actually calculated each day. Now in the crypto markets, and specifically with Quedex, all of this works slightly differently, but I just want to give you a flavor for how this works in the financial market so that when you get into crypto, you have an understanding of the key differences. Quedex futures are settled financially, meaning no US dollars are exchanged. So this would be the equivalent of the corn never being settled with actual corn, it just gets settled financially. Anyway, let's go to the platform and take a look at how all of this works. Okay, so the first thing you want to do is you go to quedex.net and you click on futures, and then all of a sudden you can see what futures contracts exist. Now, I have a 23rd of Feb contract, a 30th of March contract, and a 29th of June contract. And you're going to notice something really, really interesting. The asking prices are more expensive as the time goes up. So as the futures contract is more in the future, it becomes more expensive because you have more time. Now, it depends on who you talk to. I like more time. Time is way underrated. It is the most valuable commodity ever. I usually look at the more longer term contracts because they buy me more time. But again, there's reasons why you would or wouldn't do that. So that's the first thing to note here is the different futures contract, because like the corn example, there was an expiration date. Here there's an expiration date. And also if you go to futures, if you go to the link I showed you on the last slide, you will be able to learn all about the futures, how they settle, when they settle. There's so much information here. Here you can see their maturity dates as well. I really recommend you go and read through this. I think Quedex have done a fantastic job, and I mean this sincerely. Quedex, you really have done a good job in laying out calculations and expiry dates, etc. on your website to make this much easier for people, especially beginners. So this is really good. I recommend anyone watching this go over to this link and read through how the structure of the futures work. But getting back to the platform, this is something else that you also need to focus on. So when I highlight on this little I, so this little information, it very quickly brings up this window that tells me what the margins are. So I can see, right, the initial margin 4% and 3% maintenance margin. This is really useful. I've got the maker fee, the taker fee, and underlying is $1. This is one of the best things about Quedex, by the way. One contract is $1. So for me, I'm actually, even though I'm a financial controller by trade, my mental arithmetic is terrible. That's why I'm so good on Excel. I know Excel so well. It's because I rely on it to do all these calculations. But for one contract to be $1, it just makes everything so much more simple in your mind when you're trying to work out what's the size of the contract, how much deposit should you put down, etc. Really useful. So down here, and I'm not logged in right now, but you can have your balance, your pending orders, your open positions, your order history, wallet history. What's awesome about this platform, and for those of you who might not be aware, Crypto Wizards is affiliated with Quedex, so anything I say is going to be biased, but if you watch the videos, you'll see that that wasn't always the case. I just really like this platform. And the reason I like it, everything's laid out very, very simply. It's just here in front of me, very easy to see where my positions are, how they're performing, to navigate around trades, to click between the options and the futures. Today we're talking about futures. So anyway, let's actually place a hypothetical trade here. If I was to go, and I'm going to open up Excel over here as well. Now, if I was to go and place a trade, let's say I'm going to go and hit this right now at 10,712, and that's the price that I'm going to pay. And I'd like to hedge myself, I don't know, let's just say 1 Bitcoin. By the way, this is something else I really like about the platform. It says BTC hedged. So futures here, there's a lot of leverage going on here, and it's good to use leverage when you're hedging and you know what you're doing. There are a lot of platforms out there that try and say, hey, great leverage, you know, you can make loads of money, and you only need a little bit to make a lot, etc. The reason why those platforms do that is because they want you to lose your money. It's that straightforward. They won't even take the opposite position because they know your mentality. This is what they do. Here, it's like BTC hedge. The terminology, this is very crypto. This is also something I love about crypto. It's just a way to look after the community. BTC hedged. So here it's suggesting that you would be hedging. You would be using futures to hedge. Anyway, I want to hedge 1 Bitcoin's worth. Now we know the price of Bitcoin right now is about $10,700 as of recording this video. So I can hedge for 1 Bitcoin and not actually need $10,700 to hedge that amount with. Okay, so anyway, what I'd like to look at now is this exceptionally useful tool down here at the bottom. And what I'm going to do is copy this and paste it into Excel quickly, just to give you an illustration. And there's a few other very key pieces of information. What is the initial margin? Okay, so I'm going to write here initial margin. Sorry, I should have built this before I did the video. So initial margin. And then the other one here, I'm going to go maintenance margin. And that is that much. So the initial margin, if I look at this, that is, in terms of US dollars, $429. So to hedge 1 Bitcoin's worth, $10,700 worth of Bitcoin, I only need upfront $429. That's pretty useful. And now, if the price moves up 5%, then that is essentially me making about $535. So I deposit $429 into the trade plus the maintenance margin as well. So we just calculate that quickly. So in total, I needed $751 in total to get into the trade. And I made a profit of $535 on the price moving by 5%. Now, if I own Bitcoin, 1 whole Bitcoin, I would have made $535, the same amount, because we hedged 1 Bitcoin. And owning Bitcoin, I would have had to buy 1 Bitcoin. That would have cost me $10,700. But here it didn't. It literally cost me $429 plus the maintenance margin, so $751 to make that same gain. Now remember, if the price goes down, I lose $535. So you want to make sure that whenever you're placing a trade, you're not risking more than 3%. Actually, it should be 1 to 2% of your capital. So make sure that if you have $500 down here in terms of maintenance, that you have a significant amount of capital diversified in other trades that you're placing too. Don't go and think that you can take your only $500 that you have, your bankroll, put it in this trade, because you will lose money. You will lose your money. It'll happen. Eventually, you might make money at first, but without having that psychology of staying in the game, you're gonna lose your money. So be very, very, very careful when you're using leverage. Now let's talk about leverage. Let's go back to the Quedex platform. Let's talk about leverage. Quedex, again, very intelligently, BTC hedged. It makes a lot of sense to use leverage if you don't want to pay much of a premium and you just want to hedge your position. You know that there's something uncertain going on in the market. It could go either way and you want to protect your holding or your mining or whatever it is of Bitcoin. Then futures can be a really, really useful way to do that. They can also be very useful if you want to speculate with the price going down. So really, really useful. Now, I'm sure you've been watching this. If you're like me, you get fascinated by this stuff. So remember that Crypto Wizards affiliated with Quedex. There is a link below this video. You will get 10% off your trading commissions for the next 180 days. That is the agreement we have with Quedex, which is fantastic and very generous of them. So I really, really, really suggest that you take them up on that offer. We benefit, you benefit, Quedex benefits. It's a win, win, win. But if you decide to go and sign up without using the link, that's totally fine by me as well. The main goal here is that we are helping to give you an understanding as to what futures and options are, because these powerful tools are so overlooked in crypto and people need to get educated. The market needs to get educated. Now, saying that, what is really important is ask questions. There is no such thing as a stupid question, particularly when it comes to futures and options. I want to know what your questions are so that I know that we're targeting content that helps you. So it's just really important so that I know that if there's something I haven't communicated clearly enough, or if there's a common question that I could address by making another video, I would be more than happy to do that for you. So I really hope you got a lot of value as usual out of this video. Please share it with any of your mates or friends that you think might get value from this or be interested in it. And until the next video, talk soon.